Hello and welcome to the Anthroposcreen YouTube channel. In today's video, I'm going to talk about how you can build your wealth ethically by investing in stocks. My own personal wealth journey centers around stock market investing, so I'll start there. I spent the majority of my first 30 years on this planet in the bottom quartile of wealth in the United States. At the age of 30, I entered the workforce and quickly paid off the student loans that I had accumulated in my 20s. And after 2015, I started to invest in assets. And luckily for me, the main asset that I decided to pour most of my money into at that time was Tesla stock. I was buying Tesla stock heavily in 2017 and 18 and 2019, and a lot of people know that Tesla stock blew up in the year 2020, which propelled me from the bottom quartile of American wealth into the top quartile of American wealth in a very short time span. As the stock blew up, I purchased a home in 2020 and decided to pay off the entire mortgage by the year 2022. In the year 2025, I sold all of the remaining Tesla position, and I also sold the house that I bought. So in this video, I'll also talk about how I am positioning myself currently in the stock market. My last video was about ethical wealth in general, and in that video I ranked all of the recommended assets that most people consider from high to low. And in this video, I'm mostly going to talk about individual stocks and ETFs because it's such a long and complicated topic. I didn't think I could fit it in the other video, which was very long. It's important to note that the return that you'll get on individual stocks is not as high as the other assets that I recommend, and it's also much more risky than the other assets that I recommend. It's important to note just how unlikely you are to beat the S&P 500 in terms of compound annual growth rate by investing in individual stocks. Even professional investors who manage mutual funds and other funds cannot outperform the S&P 500 compound annual growth rate. Only 10% of these funds are able to beat the compound annual growth rate of 10% that we see with the S&P 500. It was hard to find the compound annual growth rate of your average retail investor, but the best information that I could find was that retail investors typically saw a 2% CAGR, which is just enough to match inflation, meaning that you're not really building wealth if you decide that picking individual stocks is how you'd like to invest, because the inflation rate is about 2%. One thing we'll see in this video is that there are also risk of massive losses. You could lose all of your wealth investing in the stock market. So for a comprehensive breakdown of how you can build your wealth ethically, I do recommend watching my ethical wealth video instead of this one. If individual stock picking is so risky and dangerous and has such a bad track record, why would you participate in that? Many of the safest assets that you can buy have a return that is determined by bond rates. In my ethical wealth video, I talk about municipal bonds and treasuries and other bonds that you could buy that would give you a return that is higher than the rate of inflation. However, bond rates are set by the Federal Reserve and fluctuate over time. And for the majority of the last 20 years, bond rates have been extremely low. So from 2010 until 2022, the bond rate was mostly lower than the rate of inflation, which means there was no point in buying bonds during that time period. One of the other top-rated assets that I recommend buying is the S&P 500. And one of the ways we can gauge whether the S&P 500 is overvalued or undervalued is to think about the price to earnings ratio. Generally, a price to earnings ratio of under 20 is considered a fairly valued market. So if you look at the history of the S&P 500, it usually bounces between, let's say, 8 and 25 price to earnings ratio of the entire S&P 500. We've seen in the last 30 years the S&P 500 blow up to unprecedented levels, meaning that it is overvalued. It was overvalued during the dot-com bubble around the year 2000. It was overvalued during the housing bubble around the year 2010, and it was overvalued after the pandemic, when stimulus money was flowing through the economy and people didn't have many things to spend their money on because of social distancing. In the last few years, the S&P 500 does appear to be very high, which means it could crash down at any time in the near future, which makes investing in the S&P 500 riskier than it has been for most of the last 100 years. We have had instances where bond rates are very low and the S&P 500 is overvalued at the same time. And when this does occur, you could argue that the only place you can find good assets is by buying individual stocks rather than the entire S&P 500. The S&P 500 is just a large bucket of 500 American stocks that are grouped together because they are some of the most successful companies in the country. So when you buy the S&P 500, you're not going to like all of the different companies that are in that index fund. One of the benefits of picking individual stocks is that you can focus on picking companies that you think are more ethical than some of the other companies that are in the S&P 500. Also, you could look at individual stock picking as a fun hobby, and that's something it's become for me. I spend a significant amount of time learning about what's happening in the markets, and it's fun for me to look into individual companies and invest in them. And let's be real, investing in the stock market has similar traits as gambling. It's exciting to watch a stock blow up, and it's also exciting to see it crash. There are many different strategies that you can use purchasing stocks in the stock market, but the approach that is least considered gambling is called value investing. Many people know about Warren Buffett because for decades he has been one of the richest people on the planet, and all of his wealth was built by investing in the stock market. Warren Buffett attributes his success to the book The Intelligent Investor. Value investing requires a long-term perspective. Value investors plan to keep and hold a stock for over 10 years before selling it. And the goal for a value investor is to buy a stock when its price is low and sell it later when the price is high. The trick is learning when a stock is low and when it's highly priced. And one of the ways you can figure that out is by looking at the price to earnings ratios. A price to earnings ratio is calculated by figuring out the market cap of a stock and dividing it by the earnings of that company. As mentioned before, if you can find a price to earnings ratio under 20, it's often considered a fairly priced stock. A good value investor is also going to understand how to read income statements and balance sheets and to pay attention to the quarterly and annual reports that their companies release on an ongoing basis. Value investors also recommend knowing the product of the businesses you are investing in great detail. So if a company is in an industry that you don't understand, even if it looks like a fantastic opportunity, it is not recommended to buy that company's stock. The Intelligent Investor is a very long book at over 600 pages, and it describes in great detail how you can pick and choose stocks with all of these different considerations in mind. But at the end of the book, the author Benjamin Graham says you could follow all of the different bits of advice that I recommend in this book, and you still probably won't beat the S&P 500 compound annual growth rate. Something to keep in mind. There are two ways of figuring out the gains of your stocks. One way is just to look at the total gain percentage of the stock that you hold. So let's say you bought Nvidia at $100 and it increased to $130, then that stock grew by 30% in value. But how long you hold an asset is important. Did you make that gain in 1 year or 5 years? In order to ensure that we're making an apples to apples comparison when we're talking about growth, we need to convert the total gain percentage into a compound annual growth rate, which tells us how much on average did that stock or asset grow every year that you held it. The S&P 500 compound annual growth rate is 10%. And when people are trying to determine whether they are successful investing in the stock market or any other investment, they often compare their CAGR to the S&P 500. I calculated my compound annual growth rate over a decade of investing in the stock market. If you include Tesla stock, then my compound annual growth rate was 60%, which means that I completely destroyed the S&P 500. But if you exclude Tesla stock, then my compound annual growth rate is only about 7%. So you might be able to argue that I'm a one-hit wonder. Most people know that Tesla's main product is electric vehicles. They also are involved in solar energy and batteries that are super useful in managing renewable energy in the electricity grid. All of the products that Tesla has manufactured primarily in the last 15 years are essential for climate mitigation. And I won't lie, around the time that I started buying the stock, I was an Elon Musk fanboy. He really seemed sincere about solving the problem of climate change, so much so that he was willing to share the patents that Tesla had generated with other members of the industry to try and promote the electric vehicle revolution. So around the year 2018, I started building a really large position in Tesla stock, even though I knew nothing about stocks. I was just really excited about the company and about Elon Musk. I was trying to research more about stocks so that I could feel comfortable putting so much money into Tesla, and I found the channel Financial Education with Jeremy Lefebvre. Around 2018, Jeremy started talking a lot about Tesla stock. So you can see this video was primarily about Tesla going bankrupt, and this video was his argument that the media would discriminate against Tesla, which is something that really seemed to be happening at the time. It was Jeremy who introduced me to the idea of value investing, and it was Jeremy that gave me the confidence to invest even more of my money in Tesla stock. In 2018, Tesla was just about to ramp up manufacturing of the Model 3 sedan, which was the first mass market electric vehicle and relatively affordable compared to other cars that Tesla sold. This was a very risky time to invest in Tesla because the company was not yet profitable. And Elon Musk himself warned that if the ramp to manufacture Model 3 were to fail, the company really was at risk of bankruptcy. The Model 3 ramp ended up being very successful, even though it was a little rough, and the stock blew up going into the year 2000. The company also, with the launch of the Model 3, started to become profitable. I wasn't the only one who was an Elon Musk fanboy, and as the company became profitable and more people were investing in the stock, the PE ratio blew up to just enormous levels. Above this yellow line is 200. Remember, a reasonable price to earnings ratio is anything under 20, which I marked in this pink line. So Tesla was massively valued in terms of a price to earnings ratio. I was aware of this, and I was selling the stock pretty heavily in the year 2000, 2021, and 2022, and 2023 to keep my portfolio somewhat balanced, and that's why I decided to pay off my mortgage on my house. With Tesla stock, I plan to hold it into the year 2030. I really plan to hold it for the long term. But after the pandemic, Elon Musk turned very political and to the right side of the political spectrum. And as most people know, with his political associations with Donald Trump, he ruined the Tesla brand. Also, and related, the growth of revenue of Tesla plateaued in 2023. Tesla has historically been considered a growth stock. The revenue has been growing exponentially since the company's inception. And with growth stocks like Tesla, the price to earnings ratio is often considered less important because the assumption is that as the revenue grows, so will the earnings grow. So the current trailing price to earnings ratio at any given point might not make that much sense. But if you count for the earnings in the future, the assumption is that the high price of the stock might eventually make sense as the company continues to grow exponentially. The problem is that for the last 3 years, there has been no revenue growth because Elon Musk ruined the brand. So there's nothing to justify the high price to earnings ratio. But as you can see here, this blue line is the price to earnings ratio, and it's extremely high right now, which is partially why I decided to sell out of the stock completely. The other factor was that Elon Musk was involved in Doge, which killed many climate initiatives in the American government, and he supported Trump, who killed all kinds of climate policies, which if you're interested in learning more about that, check out my climate politics video. And the straw that broke the camel's back for me was when Elon Musk did the salute and also attended the far-right ADF rally in Germany, which confirmed to me that the salute wasn't just an accidental body movement. So after that is when I sold completely out of the stock, even though I was intending to hold it until the year 2030. And it was difficult for me even then to sell out of the stock. I still think that despite everything that Elon Musk does, Tesla is one of the most ethical companies in the S&P 500. I can't think of any companies in the S&P 500 that are so focused on products that could help mitigate climate change. At the end of the day, over the years that I held Tesla, the stock increased by 20 times. And for me, the net result was gains of hundreds of thousands of dollars, and really the majority of the wealth that I built up over this time. And it meant the class mobility of moving from the bottom quartile to the top quartile of American wealth in just 5 years. Price to earnings ratios are the most important metric that we need to look at if we're picking individual stocks. So I want to reiterate what these are and talk about the two types of price to earnings ratio. The first type would be a trailing price to earnings ratio, where we take the current price of the stock, the total market cap, and we divide that by the most recent earnings numbers that we have. As mentioned, with growth stocks like Tesla, the company is often growing so quickly that it doesn't make sense to look at the trailing earnings numbers. And instead, we attempt to figure out what the price to earnings ratio is based on near-term predicted earnings in the future. So we take the current market cap price of the stock and divide it by predicted earnings, where the earnings are predicted by analysts who consider company forecasts and their own estimated analysis to figure out how much they think that the earnings of the company will be in the near future. And we use that to calculate the price to earnings ratio. The other huge earning stock for me is Palantir. I was always pretty interested in this stock because at the time I was a data analyst and had just read Homo Deus by Yuval Noah Harari, where he talks about how artificial intelligence is going to transform work as we know it today. And as a data analyst, I could completely see how machine learning and artificial intelligence could replace the work that I do and do a much better job at it. However, the stock was always considered overpriced, and when I saw Jeremy start buying the stock during a dip in the stock in mid-2022, I bought $2,000 worth of the stock following him. Within 2 years, the price of the stock increased by 14 times, and my $2,000 single investment turned into $30,000. I ended up selling Palantir partially because Jeremy recommended getting rid of it because the stock seemed overvalued at the time, but also because the CEO, Alex Karp, decided to focus the business on supporting hawkish government entities that focused on war and ICE immigration crackdowns in the United States. I don't think that the service that Palantir provides necessarily needs to serve evil interests. It could just be considered a basic service that provides services to any company in the world. Every company needs to understand what's going on in the business using data. At the end of the day, the gains that I saw with Palantir helped compensate for gargantuan losses in some of the other stocks I purchased, which I'll talk about now. Because of the scientific analysis on impacts of solar and wind and other renewable energy sources on climate change mitigation and the importance they have to climate change mitigation, I am very supportive of these industries, and I think they're very ethical parts of our economy. I am aware of the growth of solar and wind, and I have tried to invest in those industries as a form of ethical investment. One strategy that I've used to invest in renewable energy is through exchange traded funds, or ETFs, which are basically a basket of stocks along a certain theme. In this case, ticker symbol FAN is an ETF dedicated to wind energy stocks. I invested in this ETF around 2020. The bulk of my investments happened around then, but I was investing in it before then as well, and continually investing it for years. When you invest in an ETF, if you Google the holdings of that ETF, you can see exactly which stocks they're invested in. So you can see that the top stock is Nordex SSE at almost 9%. Vestas Wind is at about 8%. Enlight Renewable Energy is at about 7.84%. The problem with ETFs is that it's really hard to track how risky that ETF is because you have to understand each individual company in the ETF. I thought it would be safe to just invest in the ETF because the industry is growing at such a rapid rate. However, if you understand how PE ratios work, the growth of the revenue of the companies is not the only important aspect of investing in stocks. The companies also have to be profitable. And in new and emerging industries, sometimes there's a lot of competition and chaos. And a lot of the new companies in that industry might be sacrificing profit for growth. I spent years investing in FAN with very little to show for it. And I did eventually decide to sell because I'd rather invest in individual companies rather than an ETF. TAN is a very similar concept as FAN, only with this ETF, they're focused on solar energy companies rather than wind energy companies. However, in the case of this investment, I ended up losing quite a bit of my investment over time. So the majority of my purchases of this stock were at all-time highs, although I did start investing in it in 2018 and 2019, but I really started pouring more money into the ETF in around 2021. You can see what the top holdings of TAN are here, with Nextpower being the top stock, Enlight being the second top stock, Enphase being the third stock, and First Solar being the fourth stock. Also worth noting is that the top holdings of these ETFs, TAN and FAN, are extremely different now than what they were when I was purchasing the ETF years ago. After years of watching Jeremy's financial education YouTube channel, I started becoming more confident in picking individual stocks. And in late 2024, I decided to buy Solar Edge stock, which is a solar inverter manufacturer. Inverters convert the DC energy generated by solar into alternating current electricity needed for the grid. I was intimately familiar with the company because I was a data analyst at a solar company and knew that customers had a huge preference for Solar Edge's inverters. After interest rates started increasing, we saw a collapse in the solar industry and also a collapse in Solar Edge stock. I thought I could catch a falling knife and buy the stock up at a low price and it would eventually increase. I assumed the company would remain profitable because the solar industry seems like it was growing at an unstoppable rate. What you can see in the PE ratios down here, where the pink line is a 20 PE ratio, is that in the years where the stock was overvalued between 2020 and 2022, the PE ratio was enormous. These are the blue bars here. So I thought I was buying the stock at a time when the price to earnings ratio was more reasonable. However, I wasn't expecting the company to completely lose all profitability, which is what happened at the end of 2023. I'm not sure if Solar Edge stock will rebound, but this experience in investing really shook my confidence as an individual stock picker. And Jeremy had warned me in a video that buying solar stocks was extremely risky because he could look at the income statements and financial statements and see that the businesses were in a very scary and dire situation. During the solar crash in 2023, I also decided to pick up Enphase stock. And the story is very similar to SolarEdge, even though Enphase's business never crashed in the same way that SolarEdge's profitability just disappeared. However, I did take pretty large losses on the stock, and 65% of my investment just disappeared. I did sell the stock recently because I decided that I would only keep my money in individual stocks that Jeremy also invests in. With SolarEdge, Enphase, TAN, and FAN, I lost tens of thousands of dollars in those bad investments. I also invested in Beyond Meat because I know that the animal agriculture industry has huge climate emissions and was very excited about the potential for a vegan meat alternative. I still am excited about the potential of this business, but if I do invest in this industry going forward, I would also have to invest in a company that Jeremy does his due diligence reviewing before I would buy it. In Beyond's case, I bought the majority of my Beyond Meat shares in mid-2022, thinking I was buying it at a low in the stock after a crash, but the stock has continued to decline. And even though I didn't invest as much in Beyond as I did in those other assets that I was talking about, I lost 99% of the investment that I made in Beyond Meat, which is pretty cataclysmic. Losing money in the stock market is just a reality of doing business. And Jeremy has also picked stocks that were pretty catastrophic. One such example that I also invested in is Tattooed Chef, or TTCF. This is a business that made convenient pre-made frozen meals that were all vegan-based meals. So there was no animal products at all. And I have seen a tendency for Jeremy to pick some companies that appear to be ethical in this way. However, the company was also never profitable, and really any unprofitable company is a purely speculative play. It's extremely difficult to guess where that company's stock price should be at the point in which they convert to profitability. And some unprofitable businesses never become profitable. This is the case with Tattooed Chef, where the company eventually had to declare bankruptcy in 2023, and I lost 100% of my investment in this stock, which was thousands of dollars. Another speculative and ethical investment that Jeremy has invested in over the years is the company Honest, which is a company that was established by Jessica Alba, who I really respect for taking a strong position on climate change in the past. Also, I have a huge crush on her, and that probably clouded my judgment as well. Anyway, the company focuses on making basic necessities, especially baby products, but products that are made in an ethical and sustainable way. The company has had issues over the years and was potentially veering towards bankruptcy, but is recently in a revival period as they streamline their business and focus on more profitable products. I'm still invested in this one, and Jeremy is as well, and I'm letting it take a small position in my portfolio, as speculative stocks should take in your portfolio. Another apparent failure in Jeremy's portfolio and his recommendations is PayPal stock. This stock is what you can consider to be a value trap. Jeremy started buying it in mid-2022 after the stock collapsed. The stock is a steady growth stock, so if you can get these stocks at a lower PE ratio, which we've seen it drop into in the last 4 years, as the PE ratio has drifted down below 20 PE, which is indicated by this pink line. It appears to be a really good buy. One concern with growth stocks, though, is that sometimes, as in this case, there is a steady growth, but this might be plateauing. As you can see, the revenue somewhat curved to a flat rate, indicating there's no more growth. And this can be confusing because growth investors and value investors are a very different investing group. The current trailing PE and forward PE are both 9, meaning this is a very tempting buy. Also, PayPal I wouldn't consider as an ethical stock as ethical as something like Tattooed Chef or Honest. If anything, I would say it's a somewhat neutral product that just provides a service for people who are interested in transferring money from one person to another or one person to one business. Now is a good time to question whether publicly traded companies under this capitalist system are destined to veer towards unethical behavior. To understand this better, let's consider Karl Marx's criticism of capitalism, where he says that capitalism inevitably leads to alienation. The profit motive behind the capitalist system, Marx says, inevitably leads workers to be alienated from the work that they do. It leads them to be alienated from the product that they make, and it leads the workers and the business leaders to be alienated from other people. I also think the same line of reasoning indicates that capitalism naturally leads people to be alienated from nature in general. The most successful people in a capitalist society are people who will prioritize earnings and profit over everything else in the world. And so, as we're investing in publicly traded companies, and we understand how the price to earnings ratio necessitates that 1, companies are profitable and earning money, and 2, that profit is consistently increasing over time. Does that inevitably lead to unethical practices? And do investments in companies like Honest and Tattooed Chef and Beyond Meat and Solar Edge and Enphase, do these investments inevitably fail because the most successful companies in the world are going to sacrifice everything for the sake of profit? I do think that ethical companies that are also amazing stocks to buy because they are profitable and growing are very few and far between. But I have spent a significant amount of time over the last decade trying to find them, and I think that anyone with these savings would do well by trying to put their money into the parts of society that are less unethical than others. There are some investments that Jeremy makes that I agree with his analysis that they are probably really good investments, but I just can't bring myself to invest in those companies. For example, with a company like Meta, he has made massive profits on his investment in that company. And when he was buying it, I knew that it seemed like it was a good investment, but I just can't invest in Meta. I think that products like Facebook and Instagram are absolutely horrible for society, and overall, the company's impact on society has been extremely negative. Same thing with Amazon. I respect the company for the amazing impact that it's had on society. It is extremely convenient, but I think that Jeff Bezos is just an absolutely ruthless, although efficient businessman, and I just can't get behind the way the company treats workers and has destroyed so many businesses in society. Nike is another example that Jeremy is currently buying, and I just can't get behind it. I don't like the way that Nike has treated workers overseas who builds the shoes that they make, and I just can't buy the stock for that reason. And finally, Cheesecake Factory is one stock that he is heavily investing in, but I don't think the company is that unethical. I just don't like the business. I've been to cheesecake restaurants and it seems very soulless. I just don't like the product. So even though it seems like a good stock to buy, I can't bring myself to buy it. So where does my portfolio stand now? I have a bunch of companies that are pretty much all recommended by Jeremy, and with the exception of Honest, I don't think they're particularly ethical companies. I just think that they're less unethical than a lot of the other companies in the S&P 500, and I trust Jeremy's judgment in that they are good purchases in the long run. So for example, one category that I am interested in buying is in artificial intelligence. I do think that AI is probably going to completely transform the workforce, if not completely eliminate it. I hope that we have a universal basic income so that the people who are removed from the workforce have a way to survive. But in my own interest, I want to be invested in artificial intelligence stocks so that I'm not completely vulnerable to that inevitable change in society. So I have AMD as one play and Google as another play on artificial intelligence. Jeremy is selling Google, but I really want to have some positions in artificial intelligence, and I'm going to try and grow those over the years. Also, as I film this video, we are undergoing what people are calling a SaaSpocalypse. So software as a service companies have traditionally been considered amazing investments because they don't need to spend a lot of money to operate. They just collect a lot of revenue and are very profitable. However, on Wall Street, there is a thought that artificial intelligence is going to replace all of these software companies, and there's a mass exodus from SaaS stocks currently. Jeremy and other financial minds think that this is an overreaction and that the stocks are oversold. And so we are buying up some of these stocks that are heavily sold off right now, including CRM Salesforce, Now, ServiceNow, and Shopify. It's also nice to have some basic consumables in your portfolio. And so I have companies like Celsius Holdings, the Celsius energy drink, Elf Beauty. Even though I don't really support the cosmetics industry, and I think they definitely feed off women's insecurities. And actually, I think women are more attractive when they wear less makeup. I like Elf Beauty as an investment. I like that they sell their products at a more affordable price point, and I trust Jeremy's analysis of the company. As I mentioned, I still have a position in Honest Company, and at one point I invested in Dutch Bros. It's a very speculative play on me, but I just saw how many people were lined up in the Dutch Bros parking lots and felt like I just wanted a piece of that company. It's a very small amount for me. Also, I have two finance plays that Jeremy recommends. One recent purchase that I just started purchasing is American Express, and it kind of blows my mind to think that I'm currently investing in a credit card company. I do think credit cards are pretty evil, especially when they take advantage of people who don't use them wisely. But I guess this is just an example of how you can easily slip into an unethical world if you don't really pay attention to what you're doing. I do think American Express is a largely unethical company, and somehow I ended up buying it, mostly because I want to diversify my portfolio and include some finance in there. And my other stock, PayPal, might not pay off in the long run. Finally, I'm also hedging my entire portfolio with a Tesla short. So if the price of Tesla crashes, then I would probably make a lot of money, even though this is just a small part of my portfolio. As Jeremy explains, the Tesla short is kind of a hedge against the entire market crashing, because Tesla is such a volatile stock. If there is a massive crash in the overall market, Tesla will probably crash in a huge way, and this investment would be pretty profitable, and you can take any gains from your Tesla short and feed them into the stock market at a time when stocks are at recent lows. Anyway, I don't want to go in too much detail explaining all of these. If you watch Jeremy's financial education channel and his other channel, Jeremy Lefebvre Makes Money, he'll do a much better job explaining why these are great investments, if they still are great investments. I really want to make sure that we see the forest through the trees as I make this video, because I really do not recommend that you invest a massive amount of your personal wealth in the stock market. It is extremely risky. I hope when I showed you my failed investments in Tan and Fan and Enphase and Solar Edge and Beyond Meat and Tattooed Chef, that these scared you straight a little bit. What I do recommend, and what I recommended in my ethical wealth video, is a balance of assets. I recommend having a mortgage-free home before any other asset. Once you have your house paid off, I recommend having 10 to 30% of your wealth in a high yield savings account, so essentially in cash, ready to deploy into the market depending what happens. Right now, because the S&P 500 is so high, I wouldn't let my cash savings deplete below 30%. For the remaining wealth that I have that's not cash, my target is to invest whatever my age is as a percent in bonds. So 40% of whatever I have left should be invested in bonds, because I am about 40 years old. The remaining wealth should be invested in stocks. And if you want to avoid stocks completely, you could put all of that into the S&P 500. But my approach is to put half of the stock money in the S&P 500 and the other half of the stock money into Jeremy stocks, which I showed you in my portfolio breakdown. So, for example, if I had $130,000 that is not tied into my home equity and my home was entirely paid off, then I'd recommend taking 30% of that $130,000 and keeping it in high yield savings account. Of the remaining $100,000, I would recommend having $40,000 in bonds and then $60,000 in stocks. If you don't want to invest in individual stocks, you could put all of that $60,000 in the S&P 500 and sleep well at night. In my case, I would take $30,000 and invest it in the S&P 500, and the other $30,000 and invest it in the stocks that Jeremy recommends. I hope that we all retain some sort of ethical principles as we do allocate our wealth into certain assets. I did note that I invested in American Express, which is largely an unethical company, but when you are buying the S&P 500, you are inherently going to invest in a bunch of different stocks that I think are far more unethical than American Express. And I think most of the stocks that I did choose out of Jeremy's stocks were relatively harmless compared to a lot of other stocks in the S&P 500. Anyway, check out my ethical wealth video for a full breakdown of why I think this is an ethical way to invest your wealth into assets, and why I think it's perfectly reasonable to ensure that your wealth is tied up in assets that will gain over time rather than be depleted by inflation.